Hi traders, Gavin McMaster here from Options Trading IQ, doing a video collaboration with Bar Chart. And today we're going to take a look at the wheel option strategy. So some of you may have heard of this strategy before. We're going to dive into it and learn all about it. Before we do that, just a quick disclaimer. Everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. So the wheel strategy is a multi-step process for selling options on stocks you are happy to own. The wheel is a strategy that works best in moderately bullish markets. And by the end of this video, you'll be equipped with the knowledge and insights to confidently implement this strategy. So what is the wheel option strategy? The wheel strategy involves selling a cash secured put, purchasing the stock if assigned, then selling a call option against the long stock. Both the put and the call should be sold out of the money. If the stock rallies above the short call strike, the shares will be called away and you can start the process again. Did you know that the wheel is one of Warren Buffett's favorite strategies? He's a big exponent of selling puts on companies that he wants to buy, companies that he wants to own. So step one is selling a cash secured put. A cash secured put involves selling an out of the money put option and simultaneously setting aside enough cash to buy the stock if called upon to do so. That's going to happen if the stock price goes below the strike that you sell the put at. You'll be assigned and you'll have to buy the stock at the strike price. The goal is to either have the put expire worthless and keep the premium, or to be assigned and acquire the stock below the current price. We'll look at some examples in a second. If assigned, the put seller is required to buy 100 shares at the strike price. The more bullish the investor is, the closer they should sell the put to the current stock price. This will generate the most amount of premium and increase the chance of the put being assigned. Selling deep out of the money puts generates the smallest amount of premium and is less likely to see the put assigned. Step two involves selling a covered call. Once we take ownership of that 100 shares, once we've been assigned on the short put, we can then move to selling covered calls. And a covered call involves selling an out of the money call option against 100 shares of long stock. Covered calls can help boost the income from a long stock position. If the stock remains below the call strike, the call expires worthless and the investor can sell a new call option. They still own the 100 shares. The call option expires worthless. We can continue selling calls. The investor continues to receive any dividend payments. So while holding that long stock position, we're selling our covered calls. As long as we own those shares over the ex-dividend date, we'll continue to receive dividends as well. So some people call it a double or a triple income strategy because we're earning income from selling puts and selling calls, and we're also receiving dividends as well. If the stock closes above the call strike, the shares are called away. The investor can then sell a new put to begin the process again. So you can see here in the diagram, this is why we call it the wheel strategy. So we start at the top, we sell a put, and we receive premium for doing that. If we get assigned, we take ownership of the shares, we sell a call option. If that call option gets assigned, the stock's called away, we can go back up to the top and start again and sell a new put option. A few tips and considerations for trading the wheel strategy. Number one is you should stick to high quality stocks that you're happy to own for the long term. So blue chip companies, Dow Jones stocks, companies that have a very low risk of going bankrupt. What you don't want to do is be selling puts on risky stocks, and you might end up having to hold on to those shares for quite a long time before it comes back up to your purchase price. So you don't want to get stuck in that situation. So sticking to high quality stocks will help you avoid that situation. Choose stocks trading above their 200-day moving average. So that's a good rule of thumb. Typically, stocks that are above their 200-day moving average are going to perform a little bit better than stocks that are below the 200-day moving average. So that's a nice little rule of thumb. You could also use the 50-day moving average if you prefer as well. You can consider ETFs for their diversification benefits. So if we don't want to have any stock-specific risk, we could look at country and sector ETFs, which we'll give some examples of in a second. And that helps avoid any adverse news items that might come out for a company. There's also risk around earnings and earnings releases. Trading broad-based ETFs can help avoid some of those risks and add increased diversification. And there's a lot of ETFs that are highly liquid and very good for trading options. The fourth tip is don't get seduced by high premiums available on volatile stocks. So this is a big mistake that I see a lot of people making. They see the high premium because the stock has high volatility, and they think if the stock stays flat or goes up, I'm going to generate a huge amount of income from this premium. And that is true, provided the stock goes up. But a lot of times the premiums are high on those volatile stocks because they're going to move around a lot. You could see 5-10% moves in a day on some of these volatile names. So I would tend to avoid those, particularly if you're starting out, and not get sucked in by those high premiums. Yes, they can work really well when the stock's trending up, but when it starts to trend down, we've seen with some of these high growth names in the past couple of years, it's not uncommon to see them drop 60-70% over the course of a few months. So volatile stocks have high premiums, but they're high for a reason because they're quite risky. Another one is to use volatility around earnings announcements to your advantage, provided you are comfortable with that risk. So we've seen lots of examples recently where in the few days before earnings, volatility goes through the roof because there's this big uncertain event on the horizon. We can use that to sell those expensive puts that are trading at a high price because of the high volatility around the earnings announcement. That can be a great way to potentially take ownership of a blue chip company for a reduced price. You can sell a very short-term put, anywhere from 1 day to 5 days, really high premium in between the day you sell the put and the earnings announcement. Obviously, the risk is if the stock has a big drop on earnings, a big earnings miss. So that's the reason why there's high premium, because there's a bit of risk around that earnings announcement. But if you're comfortable with those risks, you can potentially use that to your advantage and sell those expensive high premium puts right before earnings. If the stock drops, you may need to wait for the stock price to recover before selling covered calls. What you don't want to do is sell covered calls below your cost basis. So if you get assigned on a stock at 100 and the stock drops down to, say, 85, you don't want to be selling calls at 85 or 90. You want to wait till the stock comes back up towards 100 and then sell calls at 100 or above where you were assigned on that particular stock. So you never want to sell calls below your cost basis or your purchase price. Another tip is to consider buying a deep out of the money put as protection against a market crash. Most of the time, that's not going to help. It's just going to be an added cost to your put selling, but it can help you sleep easy at night knowing that you've got a little bit of protection against a market crash, and it only costs a little bit. And it can also help reduce the margin requirements of selling puts, because there can be quite big margin requirements because you may need to come up with the cash to buy those 100 shares. Buying that deep out of the money put can help reduce those margin requirements. Some of the advantages of the wheel strategy: it's a high income strategy. So we're generating a lot of income through selling puts, selling calls. Both of those steps, we're receiving premium. We're also receiving dividends when we are taking ownership of the stock for a certain period of time. So as I said, some people call it a triple income strategy. So it's a great strategy for income. And as we'll look at when we look at the disadvantages, it's not a great strategy if you're looking for massive capital gains, because by selling that call option, the upside gains are capped a little bit. The wheel can provide a cost reduction in your purchase price of your shares. So if we're assigned at 100, but we received $3 in income from the put option, our actual cost basis is 97. That can be further reduced by selling calls against that position. The wheel strategy benefits from time decay. So options decay over time, lose value every day through time decay, and we're benefiting from that as we're selling puts and selling calls. If the stock stays flat, those options are just decaying and losing value each day, which is good for this strategy. And it works well in a neutral to slightly bullish market. So that's a great time to implement the wheel, is in a neutral and slightly bullish market. Cons or disadvantages to the trading strategy, the wheel. It's a large capital requirement. So if you think about doing a wheel strategy on a Tesla, you're going to have to come up with potentially $20,000 to $23,000 if you are assigned on those put options, and have to take ownership of 100 shares. You need to come up with 20 to 23,000 to buy those 100 shares of Tesla. So it can be a large capital requirement. If you've got a smaller account, you may only be able to do one or two of these at a time. There's limited upside with this strategy. Anytime we're selling a call option, we're generating that income from selling the call, but the trade-off is that we're capping the upside. So any gains above where we've sold that call, we miss out on. If we think about a stock like Nvidia that's had a huge run the last couple of years, trading a wheel on Nvidia, we would have underperformed because we would have missed out on a lot of those upside moves that the stock has made, because we were focusing more on the income piece. So limited upside. So you want to try and not use this strategy in a aggressive bullish market, and it'll work better in a slightly bullish or neutral market. There are large potential losses. So as mentioned before, some of these growth stocks the last few years have dropped, some of them 50, 60, 70%. That can result in large potential losses. Yes, you're selling the put, you're selling a call, you're generating some income, but if the stock drops severely, the capital losses that you're suffering on the long stock position can more than offset any income that has been received from selling the put and the call and any dividends. So there is large potential losses. With the biggest risk is if the company goes bankrupt or the stock goes to zero. That's obviously a risk. Again, buying that deep out of the money put option can help hedge or protect a little bit against some of those losses. So consider that as well. And as we talked about, it's going to underperform in strong bull markets. So let's look at some examples. Using the naked put screener, we can find put options to sell on Apple with a potential annualized return above 8%. So within our screener settings, we want to have our symbol equal to Apple, potential annualized return above 8%. I've got their days to expiration anywhere from 0 to 120. You can adjust that as you see fit. And a couple of standard screeners for volume, open interest, and moneyness. Now, Apple's a pretty low volatility stock these days, so an 8% return is kind of low, but that's actually a pretty decent return on Apple. Higher returns are available on other stocks, as we'll see, but again, higher return comes with potentially higher risk as well. So here's our results from our screener, naked put screener for Apple. We can see that top example. If we're selling the September 15th 170 put, we're going to generate about $246 in option premium. And if that expires worthless, that's a potential return of 1.5%, which is about 19.1% annualized. If we wanted to go for a slightly lower annualized return, but a higher margin of safety, we might look at the bottom section of the table where we could sell, say, the November 160 strike put. We're going to generate $315 in premium. which is slightly more than the first one. But because it's a November expiration, it's taking us longer to achieve that profit. But our break-even price is quite a bit lower as well. It's 156.85 is our break-even compared to 167.54. So a larger margin of safety on that put sale, slightly lower annualized return. So for a stock like Apple, I'd want to look at a minimum of 8% annualized return for this type of strategy. If we compare that to Tesla, we can see here much higher annualized returns because we've got higher implied volatility up at around 46 to 50% on Tesla. So again, the first example, selling just slightly out of the money at the 216.67 strike, September expiration. That's going to generate $960 in premium. So that's quite a lot more premium than we were generating from Apple. It's a 4.6% return in about a month, which is about 60% annualized. So much, much higher than that Apple example. But that's because Tesla is a little bit more volatile. And we can see that in the IV there, 46%. Similarly to Apple, if we want a little bit more margin for error, we could go down to the bottom of the table, maybe look at the 210 put for November, slightly lower return at 33.4%, but it's a 13% decline to the break-even price as opposed to a 5.87% return for the more aggressive put sale closer to the money and shorter expiration. It's all about finding a balance and finding something that works for you. One thing we can consider is rolling puts to avoid assignment. So let's look at an example and assume we sold an Apple put option with a strike price of 172.50 and an expiration date of August 25th. With Apple trading at about 173, the risk of being assigned is increasing because the stock's getting down towards that put strike price. We are not ready to take ownership of Apple stock and would prefer to roll the short put. So we don't want to take assignment yet. We want to roll that exposure out for another month or two. So here's how we can roll the put out to a future expiration date and also receive a credit at the same time. So what we would do is we'd buy to close our Apple 25th 172.50 put, and that was trading at about 150. So that's going to cost $150 to close that put that we've sold. And then what we can do is we can sell to open a new put, the Apple September 15th 170 strike put, and we could sell that for about $248. So receiving premium of $248. The net cash received is $98, and we've lowered our potential purchase price from 172.50 to 170. So the advantage of this is we can delay being assigned. We can also reduce our potential purchase price, and we get to receive a small credit for doing that as well. The trade-off is we've extended our time horizon to September 15th. So we're having to wait a little bit longer to potentially generate the premium. But that's something that you can do if you're not quite comfortable taking ownership of the stock just yet. You can look to roll that exposure. One thing I'd suggest if you are rolling and you don't want to take assignment is do it before the stock breaks through the put option strike. So make sure you keep that in mind. Some of the best stocks for the wheel strategy. For me, I like to look for high quality blue chip companies. So for example, Apple, Microsoft, Amazon, Walmart, Johnson & Johnson, Google, ExxonMobil, JP Morgan, any blue chip company that you're happy to take ownership of and potentially hold for 10 plus years. Added bonus is if they pay a nice dividend. So some of those names there do pay a decent dividend. So we can get compensated for any periods where we're holding that stock, we're receiving that dividend income as well. Another thing I like to do is look for Dow Jones industrial stocks that are oversold. So again, fairly quality companies because they're in the Dow Jones, but they've been beaten down a little bit. At the moment, Disney, Honeywell, Walgreens, McDonald's, Salesforce, and Travelers have all been beaten down a little bit in recent months. So those would be stocks that would be popping up on my radar for a potential wheel trade. Another thing is to consider country and sector ETFs such as XLE, XLF, XLK, EWA, EWG, EEM. There's a few different examples there. You can use Barchart's ETF screener to find sector and country ETFs that have really good liquidity. Take a look at those examples and you might find some more as well. For people that want to be a little bit more advanced with their trading, they could consider selling a second put to start to dollar cost average into the position. So if we look at the flow chart here, it might look a little bit complicated, but hopefully fairly straightforward. The first step is the same. We sell a put option. If the stock goes up, the put expires worthless. We've kept the premium. We can start the process again. If the stock goes down through the put strike, we get assigned. We take ownership of 100 shares of the stock and we move to step 2. Step 2 is selling a straddle or a strangle would actually be better. So what we're doing, we own 100 shares of the stock. We're going to sell a covered call above our cost basis, and we're going to sell another put down below where we were first assigned, and we're going to look to dollar cost average if the stock keeps going down. So on step 2, we've sold a put and a call. If the stock goes up through the call option, our shares get called away. We're flat again. We've received 3 premiums, and we can start the process again. If the stock continues going down and goes down through our second put, that second put gets assigned. We now own 200 shares of stock, and from there we can sell 2 covered calls and just continue to do that, continue to receive the dividends until the shares eventually go up and get called away. So starting that process, you have to be comfortable owning 200 shares of the underlying stock and obviously have capacity to do that as well in terms of the capital requirements. So again, using Tesla, if we were going to do this strategy on a Tesla, we're prepared to take ownership of 200 shares. That's going to be sort of 40 to 45,000 that we would need to allocate to this strategy. Some people may prefer to just do the 100 shares, and that's fine as well. But if you want to get a bit more advanced, you can do the 200. Just be careful not to do it on stocks that are really dropping hard, and you're just continuing to buy as the stock drops. So you want to stick to those quality companies. So there you have it, traders. We've reached the end of our journey through the wheel options strategy. Hope you found this video helpful as you explore new ways to approach the markets and build a steady stream of income. The wheel strategy isn't just about trading options, it's about creating a disciplined and systematic approach to your trading. By following the stages of the wheel and adapting it to your risk tolerance and market outlook, you can potentially harness the power of options in a way that aligns with your financial goals. Just remember, above all else, stick to quality companies and ETFs and don't get left bag holding a poor quality stock. If you enjoyed this video and found value in the insights shared, please give it a thumbs up and share it with your fellow traders. Thanks for watching, and I'll talk to you soon.